But given the recent market bounce, our next guest cautions of more downside risk, especially if things don't go exactly as the market is hoping. Joining us now is Karl Farmer, portfolio manager with Rockland Trust. Karl, welcome. What is the market mostly hoping for, and what are you most worried that it may not receive?
Hey, good afternoon. Thanks for having me on today.
You're welcome.
So what we're looking at here is that, the big story has been around the optimism that the Fed's battle against inflation has been won. In fact, if you looked at the Fed dot plot, it indicated that there'll be 3 cuts later this year, and the bond market's already priced in more, 5 to 6. So with earning growth projections of 10% or so for this year, that might be too high. And at 20 times earnings for the market, the investors really need to see results. So if we kind of delve down and look at those earnings estimates, there still were on a shade being revised lower, and slowing inflation doesn't necessarily mean costs are falling, just not rising as fast. We even saw that with Humana mentioned earlier today, with the anticipation of medical costs being a little greater. And at 20 times, the S&P really needs to win confidence in those future earnings before moving higigher.
So the 3 things that you're worried about, I guess, are that prices are high, rates may not come down as much as they are anticipated to by the market, and third, that earnings may not come in where people think they will.
Correct. On the bright side, the consumer's been very resilient. This may be the most anticipated recession that did not appear. Kind of the old adage, if you ask 3 economists, you'll get 5 predictions. None of those 5 predictions, I think, had a soft landing in the forecast. So from what we've seen so far, the consumer's been able to hold things up. So, again, as long as they can keep delivering on earnings, we may be able to justify the move we've had.
Is consumer strength part of the reason why you would pick Starbucks as an investment?
That and the fact that it really didn't participate in the rally. There were some instances that China wasn't going as well as they thought, but kind of the old saying, big trouble in Little China. This is less than 10% of their overall revenues, and they're fixing the issues. The company guidance of 5 to 7% comps and the store expansion they have in Target is achievable. It's trading at less than market multiple for better earnings growth. So that's why we like Starbucks here.
Why do you like Visa?
So Visa is a little different. Kind of fits in with that consumer resilience thread that in the face of inflation, they're still spending. Payment services has been as consistent in areas one could find. And the name's not cheap, but you pay a premium multiple for a premium business here.